The balance sheet, it represents the status of a company at a specific time point. So it shows what the company has accumulated from all the activities so far. Generally, the right side shows how a company raised capital, whereas the left side shows all assets a company has, owned, by leveraging these fundings. So on the right side, the companies, either financing their fundings by liability or by equity. So debt or equity. There's one very unique characteristic of the balance sheet is that total assets should always match total liabilities plus total equity. So the concept is that whatever you have funded through liability or equity, you're using it to generate assets or you're using it to purchase assets. So as a result, it should always be the same. The left-hand side is usually classified into current assets and non-current assets. By current and by non-current, it shows how close to actual cash the asset is. The more closer to cash, the closer the account's location would be. So for example, we have cash and equivalents, we have accounts receivables, and we have inventory. We have property, plant, and equipment, and intangible assets. Let's say that, cash is cash. So cash is recorded on the most upper side of the balance sheet. We have accounts receivables, which has the potential to be converted into cash in the near future. Usually, maybe accounts receivables, it will be converted into cash in under 3 months. So maybe it's very close to cash. Inventory, on the other hand, could take some more time to be converted into cash. So in order for inventory to be converted into cash, it first has to be sold. And if it's sold in accounts receivables, it's going to take time, and then take time to be converted into cash. So it's a little bit further, located from cash and equivalents. Property, plant, and equipment. Let's say you want to sell this property or plant, and we say we want to liquidize these items. It's going to take a much longer time. And for intangible assets, more and more longer time. So generally, the closer to cash and equivalents, the closer to cash the individual line item is. By current assets, the definition is assets that can be converted into cash within a year. That's the definition of current assets. So the limit is 1 year. So shorter than 1 year, current assets. If we say it's going to take longer than 1 year to, liquidize, it's going to be recorded as non-current assets. Liabilities as well is classified into current liabilities and non-current liabilities. In this case, less than 1 year to maturity would be recorded in current liabilities. So things like long-term debt, if you still have 4 years left over to, repay your bank or lenders of your debt, it's going to be classified as non-current. But if it's classified to current, it means that you have to now be ready to repay your debt holders. So current liabilities and non-current liabilities. And lastly, we have equity. Another view of the balance sheet that we can take is, rather than classifying into current liabilities and non-current liabilities, we can classify into operating liabilities, financial debt, paid-in capital, and retained earnings. So these 4 are the 4 ways that a company can fund its business operations. So there's a very famous interview question, technical interview questions for university undergraduate students when they're trying to get into Goldman Sachs or JP Morgan or whatever. The question is, how many ways are there to fund your business? So how many sources can you name? And I usually recommend the students to use a 4-way classification. So number one, so it's all, the answers are all in the balance sheet's right hand side. So four ways that you can fund capital. Number one, you can fund your capital by using debt. So you go to the bank, or you issue bonds and whatever. So financial debt. That's one way. Number two, you can issue stocks. You can issue stocks. You can give up a portion of your, a portion of your stake and raise capital. That's the second way that you can raise capital. Number three, you can also use what you have earned through your, operations. That's retained earnings. So retained earnings is whatever's accumulated through the core business operations. So if you have net income that's been generated, it's going to be accumulated in retained earnings, because whatever's left over, as I mentioned before, is the stakeholders, is the shareholders' portion of profit. But anyways, you can also use retained earnings to fund additional investments or operations as well. Lastly, we have operating liabilities. We can use operating liabilities as well to generate cash flow, and we call it working capital management, which we will be learning in our further advanced courses. At this point, you don't have to know what it is. But anyways, 4 ways to finance your company. And for the balance sheet, same. The balance sheet typically before operations looks like this, like in the cafe example that we have introduced earlier. Before operations, we have financial liabilities because it's before the company started operations, and we have paid in capital that you have contributed when you've started your cafe business. You have purchased property, plant, and equipment, and you still have a little bit of cash left on to utilize. Typically, after operations, what happens? So first you've financed your business. You've made an investment and operation. So this is typical flow of a business investment cycle: the finance, investment, operations. So you've produced inventory through by utilizing your property, plant, and equipment. And after the operation produces revenue, and finally it produced net income, now we have retained earnings, because net income would be accumulated on the retained earnings. We also have operating liabilities, because now the company is doing operations, and liabilities related to daily operations can be generated as well. So typically now it looks like this. And you can see that the current asset portion has increased due to profits made from the business. Now we have a huge load of cash on your current assets side. And after the result of your operations, you can choose to either reinvest in your non-current assets portion. So you can reinvest, you can make more factories for further expansion. You can use it to expand channels. You can use it to do further R&D. You can use it to make mergers or acquisitions and so on. Or you can choose to reimburse to your financial lenders. So you have two options with the cash that has been generated. And as a result, financial liabilities will decrease, non-current assets will further increase, and typically now the company would look like this. You can see that the company has grown in size for before operations and after operations, but because the company has, reimbursed a tiny portion, the company has the total company size has decreased slightly, but not as much as before. So typically, all businesses start from financing activities. We use the finance to invest in property or R&D or so on, and we use it to do daily operations. And as a result of our daily operations, we reinvest or reimburse. This is what's been showing on the cash flow statement as well. So the three companies, major activities as we discussed before: operating activities, investing activities, and financing activities. As a result of the operating activities, you can choose to either reinvest or you can use to reimburse to your lenders. However, the gist is that a balance sheet shows how you funded your business, which is typically described on the right-hand side, and the left-hand side shows what through these financing activities the company has purchased and possesses as an asset. Next, let's move on to our line-by-line items of the balance sheet and try to understand more in detail about the balance sheet.